We've got another 3 months of this. Live from New York City this morning. Good morning, good morning. This equity market down and down hard. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, policy in conflict.
You're printing money by buying long-end bonds while you're tightening interest rates.
These two things are in conflict.
There's definitely a tension there, to put it mildly.
It's like having a foot on the brake and a foot on the accelerator.
Suddenly, the Bank of England finds itself in the ECB situation.
It's about time frames.
The book says calm nerves, be stable.
Figure out how to use monetary policy to contain inflation, and then some other measure to contain financial risk.
But none of that has happened.
You need to understand the importance of controlling inflation in the UK.
And it doesn't help that central banks are late.
A lot of the UK debt is inflation-linked.
So I just think we have to buckle up our seatbelt even tighter.
They're trying to manage a short-term pressure and then move back to a long-term objective.
We're seeing, the economics of pandemonium.
Joining us now to discuss is AllianceBernstein's Gershon Distenfeld, Zach Griffiths of CreditSights. Zach, first to you, first question. Can you tackle inflation and address financial instability at the same time?
It's certainly difficult, John, and it's been a huge move over the past couple of days, but it makes sense from a financial market risk and financial market functioning perspective for the Bank of England to step in. But from a longer-term monetary policy perspective, it's certainly difficult to have them buying bonds now, saying they're going to sell bonds later, and thinking that's all going to work out with the flux in fiscal policy. So it's certainly a difficult hand for the BOE. I think making the move they did over the past couple of days is the right one, but it's going to be difficult to see how they proceed going forward.
Gershon, can you achieve those two things simultaneously?
Again, I agree. It's going to be really, really difficult. Look, we're in an environment where we're just suffering from, we spoke for years about, is the Fed behind the curve? I've heard that for 2 decades now. I didn't never even sure what that meant. But central banks in general are behind what they should have done. It's clear that in hindsight, they should have started hiking way earlier and way faster. And we're kind of in a mess now. And, in order to get inflation under control, they're going to have to keep going. And we're probably going to continue to see contradictory things coming out of fiscal and monetary authorities as their political pressures to cushion the short term. But there's really no magic bullet here. I think we're in for a period of volatility and a period of weakness.
We've seen intervention after intervention from the BOJ, from the Bank of England. The ECB had to talk about what it would do to contain spreads, even though they're set to raise interest rates even further. The Chinese are threatening to intervene, and people are asking the same question again. What would it take for the Fed to pivot, for the Fed to blink? This is what Mohamed El-Erian had to say.
They're going to pivot for one of two reasons, if they pivot. One is because recession risk has become unacceptably high. 2 is because we are very close to a financial accident. Neither of these things are good for risk assets.
Zach, if they're pivoting because of financial instability, or if they're pivoting because of recession, are any of those things bullish?
No, in short, I don't think so. I think the policy responses are much different, and you've seen challenged liquidity in treasury markets for quite a while now, and I think that's even picked up as you've seen quantitative tightening pick up. So perhaps if they're concerned about financial market turmoil or financial market functioning, that would be enacted with an adjustment in the balance sheet policy. I think that would be perhaps a reduction in the pace of QT. I think it'd take a lot for them to end QT unless you have this huge increase in recession risk, which I think they would initially make adjustments of policy with maybe pausing increases in the policy rate, but probably keeping them still in restrictive territory. It all depends on what happens with inflation. If it's still 4 or 5% and recession risk is very high, I think they don't have any choice but to at least maintain the policy rate in mildly restrictive territory. But there's going to be a bifurcation in how they respond to those two very real risks.
Gershon, this feels like lose-lose. A lot of people in this market are paralyzed by this. We heard from Max Kettner of HSBC a number of weeks ago, who basically said, it's heads you win, tails I lose. Gershon, does it have to be that way? Is it bad, bad? Bad if they hike and bad if they stop?
Well, it's certainly bad on the surface, but it always comes down to what's priced in. And, some of the strongest returns we've seen in markets, particularly equity markets, have been when things feel really, really bad. They felt really bad in 2002, in 2008, 2011 with the European debt crisis, and during COVID. The question is what's priced in. I will take slight issue with something Mohammed said. He's saying that the Fed will pivot if it becomes clear that the risk of recession is just too great. I think we're there already. I think the odds of a quote unquote soft landing have really gone to close to zero here. There's going to be pain, question of how much, and the Fed has been clear they're going to keep on going, and other central banks are going to as well. So there's really no getting out of the economic turmoil, and growth is going to slow and weaken and even go negative, particularly in Europe. But the question is, how much is actually priced in right now? I think on the equity side, you could explain a lot of the decrease in PEs and the sell-off. There's the change in long-term interest rates. That really explains almost all of it. I think on the credit side, it's a little bit more nuanced, especially as most companies in the high yield market did not lever up their balance sheets over the past couple of years.
No sign of pain in the labour market right now, that's for sure. Jobless claims coming in really, really strong. Katie Lyons has more for us. Hey, Kaylee.
193,000, John. 193. Economists were looking for 215,000. So this was well short of estimates, actually the lowest number since April. So as you allude to, we aren't really seeing real pain in the labour market yet. This is probably not the kind of data the Fed really wants to see when it is trying to engineer some more slack in the labour market. And of course, we got plenty of backward-looking data this morning as well. GDP down 0.6% in the second quarter. That was expected, but you had bigger than expected figures for PCE and core PCE, 2% and 4.7% respectively. And on that point, it's important to differentiate the difference between the price pressures we are seeing in goods versus services, because in goods, they're coming down 2.6% in these figures, but services up 4.6%. That is where the wage pressure and the tightness of the labor market really is coming into the picture. So the takeaway here is those inflationary pressures remain as the labor market is hanging in there. And that, of course, is what the Fed is trying to chip away at, which is why they say they're going to hike aggressively. And the market has come in to price in those expectations. We're looking for 150 basis points of additional hikes by early next year, 75 in November, 50 in December, another 25 in February, John.
Katie Lyons, a lot of work to do. Thank you. Thank you, as always. Gershon, last time you and I spoke, early August, you said we were too negative on growth, too confident that inflation would fall. Is that still the case for you?
Starting point matters. I think that the markets certainly are very confident. You look at where one-year break-evens are, it's like 2.4%. So if you think inflation is going to continue to be at these elevated levels, you can make a lot of money betting on it the other way. I think, look, inflation is going to come down. There's no question. Housing is already starting to weaken with higher mortgage rates. The consumer is starting to pull back. We're going to see inflation come down. The question is, how fast is it going to come down? And quite frankly, just like central banks were late to the game here in raising rates, almost certainly they're going to be late to put the brakes on. That's just the way cycles work. It's not some magic that you change policy rate and the next month the economy changes or inflation changes. There's a huge lag effect. So I think the risk of a quote unquote another policy mistake of going too far is there.
Well, Zach, never mind central banks intervening, markets are intervening. Aren't we seeing intervention by financial markets? Cracks emerging, fractures in financial stability, which are going to slow these central banks down. And ultimately, is it too much of a stretch to sit here today and say, you know what, I think we're going to have to live with inflation, high inflation, for a little bit longer because of this?
Yeah, there's some cracks showing. You're certainly seeing financial markets react to a lot of this macro volatility from central bank policy. And to us, I think Gershon made a great point that it's what's priced in. And I think there's a fair amount of risk priced in with respect to recession and slowing growth. And if you look at where the market is, it's priced in a ton more in hikes by the Fed and other central banks over the past couple of weeks. So when we think about what that means for a call for duration, we're a little bit more comfortable getting long at these levels. And if you do think that risk might be even a little bit underappreciated in the long end, then you could see yields coming down. When you see just how much yields have come up, at this point, it's starting to look a little bit more attractive, certainly than it was even just a couple of weeks ago.
Zach, this isn't typically a question I would ask for someone who's talking about buying a 10-year Treasury, but how much volatility do you have to stomach to hold a 10-year Treasury at the moment?
It's a lot, and it might be too much for some, and I think that's an important consideration for financial markets broadly. You're going to see volatility for the foreseeable future as we look through this inflation data, and central banks have made it clear that they are on a path to tighten policy aggressively, and that's probably not going to change, but exactly how much they have to do and how long they'll remain at these higher levels is the big question, and I think that's going to point to more volatility really across financial markets for at least the next 6 to 9 months.
6 to 9 months more of this, Gershon. Let's talk about high yield. It's your world. 550 on high yield spreads. You know what happened in late 2018 when we got to these kind of levels? The Fed backed away and backed away big time. No one's expecting that imminently. What do you do with 550 basis points worth of spread now?
I think the first thing to point out is we're in a very different environment in 2018. You know, we had the whole E&P sector that was ready to restructure. We had the retail sector under a lot of pressure. A lot of that's been cleansed out. You had a lot of restructurings, defaults, restructurings in 2020. And, you know, not because of any genius on the part of corporate executives, but they were just so scared by COVID that they didn't do the normal things that you see during expansions of buying back shares and making acquisitions and otherwise spending on capital expenditures. So I think that there's a lot priced in to the high yield market. You know, we focus on spreads a lot, and spreads are wider than average now, significantly wider than median, but the all-in yield approaching 10% is something that's starting to look really, really attractive to us, especially on a risk-adjusted basis versus equities.
Gershon, when you think about that, though, is that something you want to buy before you see the whites of the eyes of recession, before you get a real decent idea for what kind of depths we're going into?
I think the history, John, is that those that have the highest total returns and the best returns over time are those that delve in when things look really, really bad. As I said before, all those time periods before, you know, the best time to jump in was when things looked the worst. Can I sit here and say that this is the absolute best time? Absolutely not. We certainly could get a lot weaker. I do think, and that's what we try and focus our investors on, is that if you buy today and you wake up 2 years from now, you're going to be pretty happy that you did.
Gershon Distenfeld, Zach Griffiths, sticking with us. Coming up on this programme, the US Commerce Secretary with a message for the UK.
Markets have plummeted. The pound has plummeted. Investors, business people want to see world leaders taking inflation very seriously, and it's hard to see that out of this new government.
That conversation up next.
The policy of cutting taxes and simultaneously increasing spending isn't one that is going to fight inflation in the short term or put you in good stead for long-term economic growth. Investors, business people want to see world leaders taking inflation very seriously, and it's hard to see that out of this new government.
That was not a spoof. The Biden administration expressing concern over the UK's economic strategy. Prime Minister Liz Truss pushing back.
It's a difficult time. We're facing a global economic crisis brought about by Putin's war in Ukraine. And what was right is that Britain took decisive action to help people get through what is going to be a difficult winter.
Team coverage starts right now. Bloomberg's Lizzie Burden in London, AMH down in DC. Anne-Marie, what a moment to hear someone from this administration talk about fiscal policy in another country.
Yeah, interesting, given the fact that they've had a number of their own fiscal legislation, when you look at also the American Rescue Plan and so on. But what you're hearing right now, Jonathan, in Bloomberg News, our colleagues are reporting, is that there is some concern within the Treasury Department about the volatility in the financial markets and what that means if it bleeds over into the broader market or into other countries. Now, Secretary Yellen would not direct the UK, would not make comments directly about this head on. But you heard from the Commerce Secretary, her colleague, Gina Raimondo, it was pretty sharp in terms of what she thought was and insinuating this is a misguided approach. It also comes on the heel of a tweet from the president last week that talked about the fact that he said he was, quote, sick and tired of trickle-down economic ideology. The president and Liz Truss, the Prime Minister of the United Kingdom, clearly do not match up when it comes to ideology. The president does not think that cutting taxes and that would eventually trickle down and boost economic growth. He does not think that works. And some in the UK took that as a criticism of this government and of Trussonomics.
Lizzie, we've got a party conference coming up for the Conservatives. Is this lady for turning?
It doesn't look like it, but what might be embarrassing for Liz Truss is that Rishi Sunak isn't going. Of course, he was vying for the leadership against her. He's going to stick it out in his Yorkshire constituency. And when I'm talking to his allies who backed him in the leadership campaign, it doesn't look like they're going to Tory conference either, because they just don't want to face the broadcast interviews where they have to stand up for these policies when it's become such a massive credibility issue. It's not just the US that's criticising UK fiscal policy, it's the IMF, it's even some of Truss's own informal economic advisors. We had Gerard Lyons on the programme the other day. Now he's saying that Kwarteng seems to have taken it too far, taken his eye off the ball.
Lizzie, how is the central bank behind you on Threadneedle Street responding to allegations that they're facilitating what's taken place over the last week?
I think this is precisely the reason that it took so long for the Bank of England to step in. But remember, the reason, the intervention that they made was a financial stability intervention, not a monetary policy intervention. This is the thing that they're stressing. And this is why it makes it look like they're moving in two different directions. I think you called it quantitative confusion, because what we're happening, as well as having quantitative easing on the one hand, Hugh Pill, the chief economist, has said that we can expect a significant move in November to respond to the inflation. And also, of course, there's all this pressure to get the pound up again.
They're still talking about selling bonds at some point in the next month as well. I can't keep up. Lizzie, thank you. Great work as always, alongside AMH. Lizzie there in London, Anne-Marie down in DC. Can you just pull up a chart, just a board, with, let's say, UK 2-year, 10-year, 50-year, 30-year, throw it all up there. And look at the split, the divide here, between the stuff that the Bank of England is buying right now in the gilt market operation announced yesterday and the stuff they're not touching. So it's 20 years plus in a secondary market. That's the gilt market operation the BOE announced yesterday. 30-year unchanged, 50-year gilt yields down about 9 basis points. 10-year, 2-year, they're not in the market for that. The 10-year up 13 basis points, the 2-year up 20. This operation ends in the middle of October. Zach Griffiths, what would happen if that operation does actually end in the middle of October and we've not had a fiscal U-turn?
It's hard to imagine anything good, John, and I think that's something that's going to be very much in focus over the next couple of weeks. It really seems like it's going to be a difficult situation for the BOE to manage without a big change in the fiscal outlook, and so far we haven't heard anything of the sort. So the thought that they're going to end bond purchases in middle of October and start bond sales at the end of October, that seems almost impossible right now.
Is it almost impossible for them to wait for the next scheduled MPC meeting as well, which is November 3rd? And we've all said it, Zach, November 3rd feels like a lifetime away.
It does, and the latest remarks out of Governor Bailey and other policymakers have been firm that they want to wait till that time period, and I think having these financial market stability mechanisms in place maybe gives them that ability, but it's going to feel like a very, very long month and change to get there for them to adjust policy in response to this fiscal outlook.
Bob Miller of BlackRock had this to say. I'm going to share the quote with you all. You can see the footprints of the gilt market all over the US Treasury market in the past week. He went on to say the US bond market is being significantly degraded by non-domestic factors. Gershon, your thoughts on that? Does that resonate with you? The US bond market is being significantly degraded by non-domestic factors.
Well, I'm not sure exactly what he means by that, but there's no question that, foreign buyers are very often the marginal buyer. And, there's part of the reason you would argue that rates are not higher than they would be given what the Feds continue to do at the long end is that there's an insatiable demand for dollars out there. Like I'm gonna paraphrase what Chair Powell said at one of his recent, I forget which time it was, that, when it comes to inflation, central banks around the world are kind of, flying in the dark, trying not to, or moving around in the dark, trying not to run into any furniture. And I think, November 3rd, you said, is a mile away. I think October 3rd is a mile away right now. When you don't really understand what the short-term drivers of things, you're just going to let things sway you. You're going to get one number here, one number that. It's not going to give you a clear picture. And, to the extent I think fiscal and monetary authorities, just the chances of making severe errors are high. I mean, look, we can't even agree. No one even agrees about whether, tax cuts are good or bad for the problem. So we're going to continue to see a lot of volatility until it becomes clear that inflationary pressures are under control. When that's going to be, my guess is sometime early next year, but the jury's out.
Gershon, I think the saying was that when things are uncertain and you're in the dark, you walk around carefully. I would say at the moment, Zach, they're sprinting around a dark room getting punched in the face. And Zach, I just wonder how much further they can actually go given what's happening around the world.
Yeah, it's a wonder how many punches you can take until you just have to sit down and call it. But I think that at the end of the day, it really is going to come down to the economic data. And, so far on the inflation front, it hasn't been what they need to see. And I think Gershon's point that they respond so strongly to single data points, it's going to be difficult for that to change in the near term. In July, you had CPI somewhat disappoint. That feels like a lifetime ago. In August, it came in way above expectations, and that's what's on everyone's mind. That seems to be what really filtered into the last FOMC meeting. The dots came in even above where the market had repriced over 100 basis points over a course of a month. So it's really difficult to see how this volatility ends. And that's kind of the key, I think, that when you have policy having to respond to such dire circumstances and every data point seems to matter so much more than it did, let's say, in the end of the last cycle.
Where does the circuit breaker come from? I don't know. Gershon, Zach, to the both of you, awesome to catch up as always. Thank you. Equities negative this morning. Sterling is positive now. 109.33 on cable. Coming up, the morning calls, and later, Seema Shah of Principal Global looking at a US recession next year as her base case scenario, hers and pretty much everyone else. This is Bloomberg. Equities down 1%. Here are the morning calls. First up, UBS upgrading Kraft Heinz to neutral, $34 price target, saying inflationary concerns are now priced into shares. Evercore upgrading First Solar to outperform, $150 price target, expecting the company to benefit from the Inflation Reduction Act. And finally, Bank of America downgrading Apple to neutral, citing risks from a stronger US dollar and weaker consumer spending. Coming up, just 48 hours remaining in a volatile third quarter. Joining us, Principal Seema Shah, around the opening bell. The opening bell just around the corner. 23 seconds away from the opening bell this morning. Good morning to you. Snapped a 6-day losing streak on the S&P 500 in yesterday's session, with the biggest day of gains on the S&P going back to early August. And then we start to take it away again this morning. We're down by about 1% on the S&P. On the Nasdaq, we're down by about 1.5. That's the opening bell. All the price action in the bond market. It looks a little something like this. A 10-year that's up 6 or 7 basis points. Your yield right now, 380. In the FX market, euro dollar not doing much. Euro dollar 97.31. And in the commodity market, crude up by about 0.2%. Crude 82.30. Down at the opening bell. Let's get you some movers. Here's Katie Greifeld.
Hey, John, well, let's kick off with the world's biggest company. We have Apple on track to fall for a second day. This follows a rare downgrade from Bank of America. You have analysts warning of weaker demand for smartphones and laptops. That, of course, follows a Bloomberg scoop that Apple is backing off its plans to boost iPhone production this year. Shares lower about 2.5%. Moving on, Alibaba also under pressure after some analyst action. You had JP Morgan cut its price target, now cautious on the e-commerce giant's second quarter revenue outlook, though there is some potential upside to earnings estimates. Shares still lower. There is some green to be found in Alcoa, though. You have shares popping along with aluminum prices after Bloomberg reported that the LME plans to discuss a potential ban on Russian metals. Shares higher by about 6%. And finally, we did get some fundamental news here for this meme stock, Bed Bath & Beyond. Its results were mostly in line with expectations. they were pretty low, so that's good news. Shares a little bit higher after jumping as much as 5% earlier, John.
Aluminium's just not going to catch on in America, is it? It doesn't work. It doesn't work. It doesn't work. Katie, thank you. Appreciate it, as always. Good to see you. The Nasdaq 100 suffering this morning. Information technology on the S&P down by about 1.4% before you get excited, not 4-point-something percent, 1.4% lower. Abby has more. Hey, Abby.
Hey, John. Well, yes, big tech is selling off again after what may turn out to be a one-day reprieve within a 30% bear market for the Nasdaq 100, something that folks aren't talking about that much. But that is how much the Nasdaq 100 is down on the year. And of course, this is yields are backing up again. Yesterday, plunging in sympathy with the BOE was doing, maybe a hope that the Fed was going to somehow reverse from their hawkish tone. But that really, there's no indication to think that. In fact, as you know, some of those gilt yields are backing up anyway. This means the Nasdaq 100 is underperforming because, of course, as yields go higher, it makes everything look more expensive, especially stocks, especially the high growth stocks. Tighten liquidity. Again, it makes everything, especially the high growth momentum tech stocks, go higher. The year to date, we have the real yield round tripping it by more than 250 basis points. The Nasdaq 100, again, down about 30% on the year at this point on pace for its worst year since 2008, a clear bear market, matching the potential 3 down quarters in a row, something we haven't seen since 2008 to 2009, making it even worse because it's not just about tightened liquidity, John. It also has to do with the fact that technology and communications, think Google, Netflix, technology, of course, Apple, and some of the other chip makers, they receive about 53% and 41% respectively of their revenues abroad. That means that there's a 15% accounting FX effect. We, of course, heard about that with Microsoft pre-announcing a couple of months ago. It wasn't a big amount, but it's not a great trend or precursor. Plus, if you think about it, it makes the IT budgets of the European companies and other Asian companies buying, it gives them 15% less buying power, probably puts the focus on need to have technology as opposed to nice to have technology. Lots of headwinds for big tech.
Tons to talk about. Abby, thank you. 3 minutes into the session, we're down by 1.2% on the S&P. On the Nasdaq, we're lower by 1.5%. Just a note on sterling, appreciating for a third straight session now. Cable at about 109.70. We're up by 0.75% on that currency pair. The range this week at the low, 103.50 in the Asian session Monday morning. At the high, just a moment ago, 109.79. That is quite a range on a G10 currency against the dollar. We'll talk more about that later. Taylor Riggs, quite a range in the bond market as well this week too.
Indeed, and I want to welcome you to your second to last trading day of this third quarter as we think about what just a bloodbath really this has been. Take a look at the bond market, John. It's actually the relative outperformer. It is only off 21% or so, as you can see there. Small cap index, of course, off about 24% there at the bottom of the screen, given its correlation to dollar strength and being protected by some of the U.S.-based assets, of which are making up that index. And of course, MSCI, the big underperformer of them all. All of that folds into your world of bonds. I thought the equity market was volatile. You jumped 95 basis points on a 30-year UK. Then you plunge 100 basis points.
That's nuts.
So you're trying to find some stability at 5%. Now today we're finding some stability at 393. Maybe this will be a little bit less volatile than we have seen the last few days. So buckle up. It is a wild ride. And this really shows it. We'll just talk about points, not percent, because the VIX is up 15 points, 32. We're not getting the huge washout of 40, but the MOVE index, huge volatility in the bond market. That has been the leading indicator. And then you have the G7 currencies, as you mentioned, the pound also giving us some volatility.
You know the rules of carnage, Taylor, that you do the Dow in points and you do the VIX in percentage.
I know.
Just to make it sound more dramatic. We're more disciplined here, as you know. Thank you. Taylor, thank you as always. Taylor Riggs there. The Nasdaq 100 in the third quarter. This speaks to the volatility that Taylor's talking about, recording a massive reversal. Kaylee Lyons has more. Hey, Kaylee.
Yeah, of about 19%, wiping out a 19% intra-quarter gain. That is the biggest wipeout we have seen within any quarter on record. Absolutely huge. And of course, we've seen a similar story in the broader S&P 500 as well, in that it was okay in the beginning through July to mid-August, and then we rolled over in a material way. So where that leaves us as we head into the final 2 trading days of the quarter is set for a third straight quarter of declines. That is the biggest losing streak on a quarterly basis for the S&P 500 500, going all the way back to 2009. So we're talking financial crisis era. And of course, a lot of that pain in stocks and tech stocks in particular is from the bond market, which Taylor was just speaking to, as we have seen yields climbing in a massive way. For the second time in 3 quarters, we have seen a more than full point move on the 2-year yield, up 115 basis points just in a 3-month period. And of course, as you extend throughout the curve, those moves get a little smaller, but they're still notable. I mean, even the 30-year is up around 51 basis points. And the other big standout story over the last 3 months has been the dollar, heading for its best quarter since 2016, at one point on pace for its best quarter since 2008, up about 6% from the start of July to now, leaving every single currency in a Bloomberg basket of expanded major currencies weaker against it on a quarterly basis. The euro, the pound, the emerging markets currency index is what I'm showing here. But of course, you could throw up the yen, the yuan, places where we have seen intervention to try and stem some of that weakness that the strong dollar is causing, John.
Kelly Lyons, who's next? Been asking that question on surveillance all week. Kelly, thank you. Principal Seema Shah on the year so far says this: financial markets have suffered a dreadful first half, ravaged by a severe commodity shock, strict COVID lockdowns, and one of the most aggressive Fed tightening cycles in recent history. The second half looks equally tough. Seema, I'm pleased to say, joins us right now. Seema, let's talk about the second half of the second half. More pain to come.
Certainly. I think the first half of the second half was actually a little bit more moderate. You know, the first July, half of August, you had this almost really ridiculous optimism, I'd say, feeding into the market, and this hope that the Fed and other central banks would capitulate to weak growth. And then that realization that actually there is just one focus in town, and that is inflation, has taken all the expectations back to higher rates, lower growth, and of course, lower earnings. And that is what is pushing down the market, and it's not over yet.
Seema, it's good news, bad news, because that claims print about an hour ago, below 200K, got a lot of people thinking that. It's good news, bad news in the labour market.
It absolutely is. And this is almost where I think strong labour market is going to be the US's undoing. Because as long as the labour market is strong, the Fed has just got further and further to go. And they have to go. So they're going to be engineering a hard landing. That is almost the only way to pull down inflation. So the stronger the labour market is, the higher rates have to go. And of course, the higher rates have to go, the further things have to fall.
And they're engineering financial instability as well. Other countries are contributing to that. Seema, what kind of things do you expect to start to crack just a little bit more? We've seen it in the gilt market. Very, very unique to what's happening in the UK at the moment, with fiscal policy pushing the other way against what the central bank's trying to achieve. But how many more cracks are you expecting to see, and where and in what?
Yeah, you know, it's absolutely true. I think in the last couple of weeks, you do feel like this market frenzy is starting to really escalate. And at some point, it's going to hit that point where, you know, other things are going to break. And as you said, the gilt market, it is specific to the UK. But this is all driving in the same direction of concerns about inflation. Governments may be trying to offset growth, probably certainly not in the right ways in the UK. But you can see that there is the same movement everywhere. Now, we are looking really towards the dollar. Where is that going to happen? Historically, every time the dollar has got to this point, something has happened. Be that some kind of intervention, some kind of emerging market crisis, potential liquidity problems. But that's what we're watching. And then throw into the mix quantitative tightening. I do think that there's been a little bit of an underestimation of the impact that could have. So you're looking at really, really tight liquidity conditions, which is only going to get worse into a slowing economy.
Seema, all the conflict we're witnessing right now, and let's start from the top of the pyramid, the very top, the Federal Reserve against the rest of the world. It's the Fed against the BOE, the ECB, the dollar's dominant. Those two countries, those central banks are trying to get a stronger currency, can't get one. Within the UK, the conflict between fiscal policymakers and monetary policymakers. Within the central bank, the conflict between trying to preserve financial stability and trying to get inflation lower as well. Seema, we can talk about the risks associated with all of that conflict. Are there any opportunities out there off the back of it?
That question is getting tougher and tougher and tougher. So look, there are going to be opportunities. You know, they're really the small ones to pinpoint. You know, things that can potentially work out well, do well in a recessionary environment. The truth is that things are getting tighter and tighter and tighter, as you said. So now, for us, for investors, it's really about increasing your liquidity, right? Because when that bottom comes, given how far valuations have come down in so many markets, there will be some fantastic opportunities. And when it comes, it will come very, very quickly and furiously. So we do think that if anything that you're thinking about within your portfolios, start to increase that liquidity because there will be opportunities and you need to take advantage of it. As of today, we would be underweight equities, you're underweight credit. Real assets are probably the one area that continue to throw up some opportunities, things like listed infrastructure, even commodities, but as long as you're taking a kind of a 5-10 year horizon. But really the number one message from us is increase your liquidity so that you are able to take advantage of the opportunities.
Nasdaq down 2%, S&P down 1.6% in today's session, about 11 minutes in. We've seen capitulation, I wouldn't call it that, intervention from the Bank of England. We've started to see just a little bit of softening of the stance in China too. China right now allowing some cities to cut the minimum first home loan rates. Seema, who's next? Where do we start to see that just little bit of a pivot? I'm not talking about the Fed, I'm just talking about elsewhere.
Look at where the most tensions are. Who's really, really starting to struggle? Where is the economy starting to struggle fundamentally? And I'm not talking about like a U.S. recession, which is, we think, going to be short and shallow. This is going to be somewhere where households are really starting to struggle. And actually, there will be a point where the tension gets too great and central banks almost have to change strategy. But you have to pick out which of the regions. It's not going to be in the U.S. because, fortunately, I should say, the economic conditions are not that dire. You look towards Europe. And actually, I think that the ECB, it can raise rates 75 basis points in the next meeting, maybe another 50 at the one after that. But then you're really pushing up against economic tensions. So I'd be looking at everywhere but the US for some kind of capitulation.
Italy yields up big time too. It's not just the Bank of England, it's the ECB that's got to think long and hard about this stuff too. We're up 10, 11 basis points on Italian 10 years today. Seema, thank you. Seema Shah there. Yields up almost everywhere. The Italian 10-year, the ECB talking about hiking rates and QT. Do you want some more Fed speak? It's coming right up.
The federal funds rate next year would increase to 4.5 to 4.75. It's pretty clear that everybody has in mind a continued increase until we get to that point, I'd say like March 2023.
Before the week is out, you'll hear from Mester, Daly, Barkin, Brainerd, Bauman, and then Barkin again, and then Williams, and a whole lot more. That's next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Kemi Badenoch, UK Secretary of State for International Trade. This is Bloomberg.
The federal funds rate next year would increase to 4.5 to 4.75. The median of 19 participants said it would be 4.5 to 4.75. And if you kind of look at the general pattern, I think it's pretty clear that everybody has in mind a continued increase until we get to that point. I'd say like March 2023, we'll be at that point.
Chicago Fed President Charles Evans there, just one of many Fed officials taking center stage this week with markets remaining under pressure. Bloomberg's Ed Harrison writing, quote, "Yes, that pain you're feeling is intentional. It makes the Federal Reserve's job easier." I'm pleased to say Ed Harrison joins us right now. Ed, why does it make it so much easier?
It makes it a lot easier because they need to get rates up in order to ease the economy, make sure that the economy is moving in the direction they want. But you have to think about the political consequences here. I mean, the Fed, which wasn't elected, by the way, is basically saying that it wants people to lose money or on the value of their homes, the stock and bond markets, throw people out of work, in essence. And they reside in Washington, obviously, so they have to walk a fine line. That's why I think that they're going to get to 4.5% and not much more, despite what Charlie Evans just said.
Ed, I was having a really strange conversation this morning, and it is strange to sit there and say that jobless claims below 200K is bad news for the Fed. I'm not sure a lot of people in this country can get their hands around that, Ed. Why, for this Fed, good news in the labor market is bad news for them?
Well, it's the essence of their being behind the curve. I mean, because you have three dichotomies here. You have the U.S. versus the rest of the world. That's why we're seeing what's happening in the U.K. We have financial markets versus the real economy. The real economy is doing just fine, but the financial markets are starting to fall apart. you have retail and housing on the one side, which is in recession, and you have services which are doing just fine on the other side. This is the essence, the Scylla Charybdis course that we're on because they're behind the curve. So I think that we've actually hit peak hawkishness because of that dichotomy. I don't think that they get to 4.5% in 2022. I think that they, despite what Evans was saying, that they're going to get to 4%, maybe 4.25%, and that's it, because they have to slow the pace or something more important is going to break in the market.
The negative feedback comes from financial markets, Ed. We're arguably seeing that in the UK. I think we are this week, that's for sure. For the ECB, it could come from Italy. Ed, is it international for this Fed? Is it something domestic? Is it liquidity in the Treasury market? Can you identify what that circuit breaker might be for them?
Yeah, I think that when it's all of the above in many ways. Really, you think about CLOs. There's not the uptake there. I think that that's one place to look for in the domestic economy. Another place to look for is housing. We saw the numbers in terms of home sales, pending home sales, just plummeting to almost a record decline month on month. So these are the things that will tell them that we're already seeing. If they're not backward looking, if they're forward looking, they'll see this as this is going to eke out into the rest of the economy. It's not going to just be retail and housing. It's going to also be increasingly services as well. And so they're going to have to slow the pace. They can't do 75 basis points or they're going to have a financial accident.
Ed, I've been meaning to get you on for a while. Thanks for being with us. Let's do it again soon. Don't be a stranger. Ed Harrison there on the latest. His view on where he thinks this Fed's going to go. One thing for sure, we're seeing a lot of blinking and a lot of intervention. This from Germany. Did you ever expect to hear this? Planning to borrow 200 billion euros to tackle surging gas prices. Finance Minister Christian Lindner saying in a press conference, we can put it no other way. We find ourselves in an energy war. Maria Tadeo from Brussels now for more. Good morning, Maria. How big is this effort going to be?
Look, it's huge. It's 200 billion euros in new debt for a country like Germany, where that's always a difficult conversation. But what it shows fundamentally, one, is that bad foreign policy comes with a price tag. We see it today in the words of the German finance minister. He concedes now we are in an energy war, and this plan, which he calls an umbrella, a shield for German consumers and households and businesses, is the response that the country is putting forward to Vladimir Putin's blackmail. Now, there's a lot of questions around the implementation of this thing. There's a lot of questions in terms of what this will do to demand destruction. That has been a key factor in the German economy. But overall, a lot of clouds for the German outlook. You have inflation now at 10% in an economy at the end of the year, potentially in contraction. So yes, this is big. It is significant. It also shows the magnitude of the problem. It shows that the German government is now aware of the storm that's about to hit the country. But again, there's a lot of question marks around this. And we've only seen the start of the autumn season. We're in September, Jonathan. We still have months to go before we get to December. So again, a lot of clouds around this.
Maria, let's catch up tomorrow on this. The conversation continues. Maria Tadeo there on the latest package out of Germany. Yields up in Germany. Double-digit inflation in Germany that the ECB is going to try and respond to, and at the same time worry about what happens in Italy. Reminds me of what's happening in the UK at the moment. Up 71 points yesterday on the S&P. Down 71 points today, now down 67. We've basically taken back yesterday's move. On the Nasdaq 100, we're down by 2.3% with some sector price action. Here's Abby.
Yeah, big round trip here. And that Nasdaq 100 you were just talking about, John, now at its lowest level since October of 2020, when there was a big tech wreck ahead of the election. Right now, relative to the S&P 500, bearish action, the worst day in 2 weeks. All 11 sectors down. The tech index, the tech sector's down the most. Discretionary real estate's in there too, because of course those dividends don't look as good with yields higher. But tech, communication services, most sectors down by more than 1%. So we're not getting a reprieve. Now on the month, it's also equally bearish, more bearish, not surprisingly. All 11 sectors are down. The best sector is healthcare, down 2.1%. But the worst sectors, it is real estate, and again, that has to do with that's a high dividend yield sector. When yields are higher, those dividends look less attractive. Energy down with oil, materials down with the sell-off in commodities, and there's technology also down as yields are higher, just less attractive.
Abby, thank you. Up next on this program, your trading diary. Yields up, stocks down. Rinse and repeat. How many times have you heard me say that this year? 25 minutes in, stocks down by 1.8% on the S&P. On the Nasdaq 100, we're down 2.4%. In the bond market, 2s, 10s and 30s, yields pushing higher once again. On a 2-year, just short of 420. On a 10-year, about 378 with a monster range on that particular maturity so far this week. That's the price section. Is the trading diary. President Biden meeting with heads of Pacific Island nations at 3 p.m. Eastern. The Fed speak continues. Mester and Daly speaking throughout the day. And it's Barkin, Brainerd, Bauman, Williams on Friday. And we round out the week with PCE deflator, personal income and spending numbers. And we'll get the UMich sentiment survey as well on Friday too. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, and here are the top market stories we're following for you this hour. Risk-off returns to the markets from the U.S. to the U.K. Investors are shrugging off support from the Bank of England, and they're bracing for more volatility. And we're going to break down what's driving the market action with Amy Wu-Silverwin of RBC. Plus, we'll speak with a former economic advisor to UK Prime Minister Liz Truss as she doubles down on her fiscal plan and signals a U-turn on the horizon and a trail of destruction. Hurricane Ian barrels across the United States, leaving scores of people missing, millions without power, and billions of dollars in damages. We're going to go on the ground to Florida to bring you the latest. And from New York, I'm Shanali Basak with my co-host in London, Guy Johnson. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, that relief rally did not last very long.
I think we're absolutely flat on a two-day basis. I was just looking at it, Shanali. The SPX, the S&P, almost exactly flat. So we've come up, we've come down. But this speaks to what we're seeing at the moment, isn't it? Incredibly whippy markets. And we're seeing it all over the place at the moment in a multitude of asset classes. And this is where the risk lies. People just can't cope. Their risk models can't cope or allow them to cope with this kind of volatility.
They sure can't cope with the volatility, and you have to wonder how much leverage is left in the system. I know that we're going to be talking a lot about that. Think about how many trades, Guy, are just so crowded, from equities to the dollar to treasury markets, and that leaves a lot of people vulnerable if we see another leg down.
Absolutely. I think yesterday was emblematic of this challenge. The last few days have been emblematic of this challenge here in the UK. There is leverage still in the system. It's not where you necessarily expect it to be. I think smarter people than me had figured out that there probably could be a problem in the pension market here in the UK. But what it highlights is that there is still leverage in the system, and that leverage can pose huge problems and do so very quickly. So Shanali and I were kicking around this a little bit earlier on, trying to figure out what our question of the day is. And after what we've seen over the last few sessions, Shanali just alluded to it, how much leverage is left in this system? And more precisely, where is it? Joining us now to try and answer these questions, Bloomberg's Vincent Signorelli and Bloomberg's Katie Greifeld. Katie, the last couple of days, the UK has been the epicenter of the action, and we've seen leverage and the impact that it can have. How much leverage is left in the financial system right now?
It's a really good question. I went on a little bit of a wild goose chase trying to find you an answer this morning. If you look at margin debt, which is a pretty good measure of how much retail players have in terms of leverage, it's still $687 billion, which is a lot, but it's much lower than levels that we saw, especially over the past 2 years. So it's still out there, but it's come down a lot. That makes a lot of sense when you just think about the drawdown that we've seen. When you think about more of the institutional players, it's really, really hard to judge. Anecdotally, we have heard that a lot of people have been flushed out. Maybe they've gone to cash. It's a scary market out there. So it's hard to judge, but there is a lot of fear as we get into maybe the second leg of this bear market that we could see more leverage fuel blowups similar to our Archegos that we saw year or so ago.
And that's on the more extreme end of the spectrum. On a more simpler end with the pensions in the UK, you saw all that hidden leverage. And Vince, you know, the reality is more than 10 years of leverage is going to take a long time to unwind. So do you think that the market that is trying to get back in might find that that could be painful as more trades can still be unwound?
Yeah, I think stepping in right now is definitely a painful trade. I mean, the only people who I talk to who are really involved in this are day traders, and that's because they're in and out. They're not long-term players. They're not buying now to hold for sometime next year. I think there's been a lot of outflows. Lipper keeps these numbers from funds, both the high-yielding funds and the investment funds. There's probably a fair amount of money in cash, but it's cash that's not really willing to be put to use. As you guys were mentioning earlier, the reversal from yesterday, I think that speaks of more positioning in the markets. Yesterday, and we've seen a lot of trades stretched out to 2, even 3 standard deviations. So yesterday was just a short squeeze based on, not really news in a way for equity markets. That was more of a stability thing the Bank of England was doing for the fixed income markets. And then today we're seeing it just revert, which is the sentiment of the market is still short.
The bigger picture, though, and Shonali was talking about this, though, Vince, is that we are seeing a paradigm shift. We have had 10 years plus of interest rates low or falling. And the logical thing to do in that kind of environment is to gear up. We're now changing the pattern. We're now changing the model. You've been through a number of these crises. How long do you think it's going to take to shake leverage out of the system, for everybody to unwind the positions that they have, for that mentality to change?
I think it's going to take the Fed pushing us in a recession, and I think that's very, very highly likely. I mean, we heard Bullard again today. We're going to hear more Fed speakers today. None of them are taking a foot off the gas. They all are saying that rates are high and need to go higher. We heard it yesterday as well from a series of Fed speakers. I think the Fed is we saw it this morning in inflation numbers. Higher again as well, unfortunately. And so that's just going to gin them up and keep them pushing rates higher. The leverage will stop and the pain will stop in a strange way when we get pushed into a recession, because that'll take the Fed, that'll give the Fed pause.
We have headlines crossing the wire about where the Nasdaq is headed, and it's not very pretty. The slump is extending to 3%, reaching its lowest levels since June 17th. And Katie, on the sidelines here, you were talking to me about just yesterday, people trying to get back in. How are those trades today being unwound already?
Not great, Shonali, quite honestly. I mean, if you look at the ETF inflows, which I track very closely, about a combined $5 billion went into the Qs, went into SPY. To Vince's point, really, I think the Fed speak is going to rule the market over the next few days, because if you think about what fueled that dip buying, it was the Bank of England coming in, intervening in the bond market, sort of a reminder that central banks still have your back, but the Fed, we know, is very intent on getting inflation down. Yep. That's going to be a painful process. You're seeing that in the price action this morning.
Vince, to both of your points, though, you talk about the Fed causing a recession. What we saw yesterday was the Bank of England switching from its monetary policy role to its financial stability role. Basically, the grown-ups in the room said, we got to fix this. There's a big problem here. We need to take action. And I'm wondering whether or not we are approaching the point where other central banks are going to find that problem as well. Rates are going up very quickly. US mortgage rates jumping to 6.7%. That's the highest level since 2007. We are approaching potentially the point at which financial stability risk becomes more important than inflation risk. And I'm wondering how you think central banks will deal with that and how the market will manage it.
I think you make a really good point, and I think financial stability risk is probably a little bit closer here in the U.S. Than folks are pricing in. We've seen mortgage payments basically doubled over the last 2 years, and we're seeing it in home sales dropping. We're seeing it in just about every economic indicator is dropping, even though the Fed is standing pat and pushing hard and raising rates. They very much, with a strong dollar, could see a situation where they actually cause a fiscal crisis. We're going to get the next round of earnings coming out, and it's probably not going to be pretty for the large cap corporates who don't really hedge their FX exposure. And dollars at records highs, that's going to hurt earnings. And we're going to see issues, I think, with individual leverage based on where rates are. And you're going to see it in the housing market, where this whole forbearance is done and landlords are trying to recoup gains by raising rents so aggressively. So people just can't afford what's coming down the pike, and that's going to cause some major issues.
Trouble ahead. Bloomberg's Katie Greifeld and Vincent Signorella, thank you so much for your time. And coming up next, we're going to dive deeper into the markets, what's underneath the surface, with Amy Wu Silverman, RBC Capital Markets equity derivatives strategist. She joins us on our question of the day next. This is Bloomberg.